want to get your reaction to the Fed minutes, to what we're seeing in equities right now as the major averages do tick higher on this news, although keep in mind still well off the highs of the session.
I think I agree with what Rick kind of concluded his comments on, which is to say no surprise. There wasn't certainly anything in there, given all the other Fed speak that's been conducted subsequent to the meeting, to suggest that there's any deviation from their unconditional commitment to thwart inflation at almost all costs, whether it's the labor market or the economy. And so for investors, we continue to urge near-term caution until we get a couple of more inflation prints that provide any evidence. And there are certain things that are, I think, leading indicators to inflation that perhaps suggest disinflation may be in the pipeline. The question is when it's going to evolve to the point where it actually influences the prints that come out either on headline or the Fed's favorite gauge, the core PCE, that enables investors to take some comfort in the fact that the Fed may pause or at least conduct a dovish hike in which there'd be some evidence that they're likely to take their foot off the brake, but that's not anytime soon.
Okay, so when you talk about urging caution, what does that look like in terms of putting money to work?
Well, for us, it means that we've suggested to investors not taking an abundance of risk either by way of their equity positioning in portfolios, in other words, the high degree of cyclicality or a substantial ownership of things that are selling at price to hope ratios. In addition to that, it means owning energy, which is a cyclical sector, but nonetheless one that has its own idiosyncratic supports relative to supply constraints. Healthcare is another sector we like, kind of defensive growth. And from an asset allocation standpoint, we believe that investors should have no more than what their target weight to equities is in their portfolio, given their bespoke risk budgets, given the fact that we could plumb lower levels than what we've seen so far before this is all said and done, particularly if by chance we continue to see the economy devolve into an outright recession.
But these are all cheerful thoughts we're having here, Mark. Let me turn to a couple of stocks that you like. One, both of which are often mentioned, one more than the other. Number one is Chevron. I get it, up significantly this year. The other is Thermo Fisher, medical device measurement taking devices and so on and so forth. This one is down 25% year to date. What's going to turn Thermo Fisher and other of those defensive healthcare plays, what's going to turn them around?
Well, I think a couple of things. I think investors looking at the long-term prospects for a company like Thermo Fisher that really spans the pharmaceutical and biotech universe in terms of its medical tools and equipment that it sells across varieties of industries within pharmaceutical, and obviously the development of further genomics and the likelihood that we continue to see some level of merger and acquisition activity by big pharma who need to defend against patent cliffs that are either going to develop through their own pipeline efforts or acquire it, the kind of growth that they're going to need to persist if the regulatory climate continues to stiffen. Or, on the other hand, if we get some kind of regulatory relief by way of what transpires in the election here in another month or so, perhaps opening up some of the enormous amounts of cash that they're sitting on today.
Mark, thank you very much. Always good to see you, sir.
Thank you, Tyler.
Mark Luschini.